In September 2008, someone was still working on the 34th floor. They didn't know yet. In our last episode, we traced how money went digital, from telegraphs to Bitcoin. But in the autumn of 2008, the digital financial system nearly destroyed itself. The numbers were green. They had been green for years. Green meant safe. Every morning, the machine started the same way: coffee, subway, trading floor. This was the cathedral of modern finance, built over decades since the deregulation of the 1980s. Hundreds of screens, thousands of trades per second. A trader's hands could move millions between keystrokes. The wedding ring was the only personal thing visible. In rooms like this, instruments were designed that their own creators couldn't fully explain. Documents stamped confidential contained risks that would become everyone's problem. Bloomberg terminals, the nervous system of global finance. Every bank watched the same numbers. The analysts worked through the night. They were 26 and exhausted and making more money than their parents ever had. From above, Lower Manhattan looked like a hall of mirrors. Confidence reflecting confidence. The products were designed to be unreadable. Complexity was the feature, not the bug. Across America, in the years between 2003 and 2007, identical houses stood in identical rows, each financed by a mortgage that had been sliced and repackaged. Mortgage brokers approved loans with the enthusiasm of assembly line workers. Volume was everything. A family signed their name. A 30-year commitment entered into over a kitchen table. They called them collateralized debt obligations, products invented in the 1990s but weaponized in the 2000s. Layers of risk stacked like a wedding cake. The rating agencies stamped AAA on instruments they barely understood. They were paid by the people who created them. When construction stopped mid-sentence, the half-built houses stood like questions nobody wanted to answer. Empty rooms full of sunlight. The American dream had been securitized, tranched, and sold to pension funds in Norway. Foreclosure notices arrived by mail, one household at a time. The crisis was already systemic, but it felt personal. The trap was in paragraph 7, the adjustable rate that adjusted upward, the fine print that cost families their homes. A few economists saw it coming. They gave lectures to empty rooms. Dissenting reports were filed, then recycled. Groupthink isn't a conspiracy, it's a climate. The headline said everything was fine. Champagne confirmed it. From corner offices above Central Park, the view was magnificent. The blind spot was directly below. Credit default swaps, insurance on debt that might never be repaid. The idea was elegant. The consequence was catastrophic. Luxury towers rose floor by floor, each one a monument to borrowed confidence. End-of-year bonuses were celebrated with champagne, record profits, record leverage, record blindness. The black cars waited. The infrastructure of excess ran on schedule. Bonus checks with many zeros, the rewards of a system that had confused risk with profit. Farmland became subdivisions. Demand was manufactured, then mortgaged, then securitized. 30-to-1 leverage. For every dollar of reality, $30 of faith. Marble lobbies and security guards, the architecture of finance projected permanence. That was the point. Deals closed with handshakes, trust measured in basis points, confidence as commodity. In March 2008, the first crack appeared, not in the market but in the glass. Bear Stearns, the fifth largest investment bank, founded in 1923, destroyed in a single weekend in March 2008. Breaking news, 2 words that would define the autumn. Emergency weekend meetings, shirts rolled up, coffee cold, the rituals of controlled panic. Phones rang unanswered. The calls nobody wanted to take were the calls that mattered most. The Federal Reserve, the institution of last resort. The lender when nobody else would lend. Behind closed doors, decisions were being made that would cost trillions and save the system, or at least preserve its shape. That summer, Wall Street was quiet on weekends. The calm felt deliberate. The risk models showed green, every indicator normal. The algorithm couldn't see what was coming. Fannie Mae and Freddie Mac, government-backed, mortgage-backed, and cracking. September 2008. In retrospect, every date that month looks inevitable. AIG had insured everything. It turns out you can be too connected to fail. September 12th. The heads of every major bank were summoned to the New York Fed. A fortress built for exactly this. Nameplate after nameplate around the table, Goldman, Morgan, Citi, J.P. Morgan, the entire system in one room. Hank Paulson, Treasury Secretary, former Goldman Sachs CEO, was on the phone. The roles had merged. Whiteboards covered in diagrams of a system so interconnected that saving one part meant saving everything. 3 a.m, takeout containers, the last weekend of the old financial world. Mergers were being negotiated not as strategy, but as survival. If you can't stand alone, merge or die. A Lehman employee badge on a desk. By Monday, it would be a souvenir of a company that no longer existed. From the 50th floor, the people below looked small. That was always the problem. Secure phone lines between Washington and New York. The decisions made that weekend would echo for decades. Sunday night, September 14th, every floor of the Lehman building was lit, 158 years of history, and 12 hours left. Monday, September 15, 2008, dawn over Manhattan. The morning, everything changed. Bankruptcy filed. The words on every screen, in every diner window, on every phone. A man carrying a cardboard box through a revolving door. His personal effects, his professional identity, gone. They filed out one by one, boxes and bags, 25,000 employees, the exodus. A framed family photo, carefully placed in a box. Inside every institution, there are only people. Trading floors froze, screens turned red, phones rang and rang, the machine stopped. The Dow Jones fell 700 points, the largest single-day point drop in history at that time. Both hands on his head, mouth open, the physical language of a system failing in real time. In electronic store windows, every screen showed the same footage. Pedestrians stopped and stared. Finance had become weather. On the floor of the New York Stock Exchange, the last human traders gestured frantically. Paper scattered like confetti at a funeral. The contagion spread by time zone, New York to London to Frankfurt to Tokyo, around the world in 36 hours. The city of London woke to rain and to the news. The crisis had crossed the Atlantic overnight. Tokyo, Hong Kong, Singapore, the screens were red in every language. When ATMs showed out of order, the crisis became real for people who had never heard of a credit default swap. Banks stopped lending to each other. Trust, the invisible infrastructure of the entire system, evaporated. Credit froze, car dealerships emptied. The real economy discovered its dependence on the financial one. Homes became auction items, families became case numbers, the language of loss was bureaucratic. Loading the car, leaving the house, the address that was supposed to be permanent. A padlocked door with a bank notice, dead leaves on the porch. This was what systemic risk looked like from the front yard. From the air, the ghost neighborhoods told the story. Green pools, brown lawns, moving trucks. Suburban apocalypse. Washington had to act. The question was how much, how fast, and who would pay. Paulson's first proposal was 3 pages long, $700 billion. No oversight. Congress balked. The final legislation was hundreds of pages. TARP, Troubled Asset Relief Program. Troubled was an understatement. Ben Bernanke, a scholar of the Great Depression, was now living inside one. His textbooks hadn't covered this. The printing press ran, not literally, digitally, but the principle was the same: create money, flood the system, hope. The first vote failed. The market dropped 800 points in minutes. Congress reconsidered. The numbers on the screens were the largest losses ever recorded. Records kept breaking in the wrong direction. On the streets below the towers, people held signs. Where did the money go? It was the right question. Bailout checks were signed. Taxpayer money flowed to the banks that had created the crisis. The architecture of moral hazard. AIG received $182 billion, too big to fail, too interconnected to punish. Behind closed doors, the crisis was bills and final notices and a kitchen table and no answer. Unemployment lines wrapped around blocks. Suits stood next to uniforms. The crisis was democratic in that way, at least. Retirement accounts lost half their value overnight. A lifetime of saving halved by a weekend of decisions she had no part in. Main streets emptied. Going out of business signs became the most common signage in America. Cranes froze against gray skies, construction stopped, rebar exposed like bone, the economy's skeleton visible. A pink slip beside a still logged-in computer, the personal notification of systemic failure. Food banks in wealthy suburbs, good coats in long lines, the crisis that was supposed to be someone else's problem. A car for sale outside a foreclosed house, 2 crises in one frame, loss multiplying. Paperwork with a lawyer, reading glasses, a pen, the slow, quiet process of financial unwinding. Cubicle walls came down, fluorescent tubes exposed, the architecture of work itself dissolving. A Lehman employee's box and a 1929 headline, 79 years apart, different decades, same posture. History doesn't repeat, but it rhymes. The Weimar wheelbarrow of 1923 and a modern stimulus check of 2020. Different scales, same solution. Print more. The Ming emperors printed money in the 14th century until it became wallpaper. We printed trillions and called it quantitative easing. In 1796, the French burned their assignats. In 2008, we just clicked a mouse. Nixon cut the anchor to gold on August 15, 1971. 37 years later, in 2008, we discovered what a ship does without an anchor in a storm. The Federal Reserve's lights burned all night. The emergency that began in 2008 never quite ended. Press conferences replaced markets as the main event. A chairman's word could move trillions. Interest rates hit 0, the bottom of the number line. Nowhere left to cut. Quantitative easing. Creating money from nothing. The alchemist's dream achieved by committee. Government bonds sold at auction. The future mortgage to pay for the present. A very old story. The crisis crossed from banks to nations, Greece, Spain, Italy, sovereign debt, the debts of countries themselves. Protesters in Athens, tear gas, the crisis reaching the birthplace of democracy and the birthplace of coinage. Austerity budgets cut public services, hospitals, schools, pensions, the human cost of sovereign rescue. Exchange rates swung wildly. The floating world Nixon created was now spinning. The Bank of England Threadneedle Street. The institution William Paterson founded on debt was now drowning in it. 1 year later, same building, same suits, bonuses returned as if nothing happened. Bank CEOs testified before Congress. Microphones, water glasses, prepared statements, accountability as performance. Subpoenas were issued, investigations opened, almost nobody went to prison. Tents in Zuccotti Park, handmade signs among skyscrapers, "We are the 99%, protest as symptom." Where Lehman once stood, a new tower rose, the city that rebuilds without remembering. The crisis became books, then movies, then streaming content, disaster metabolized into entertainment. Dodd-Frank, thousands of pages of new regulation. Banks would spend years and millions weakening every paragraph. Meanwhile, in a server room, algorithms were already building the next machine. Faster, colder, less human. The Lehman sign came down by Crane, the name that defined a crisis becoming an artifact. The charging bull still stands. Tourists still take photos. The symbol endures after everything. By 2012, central bank balance sheets had gone exponential, trillions created in months. By 2015, housing prices were rising again, bidding wars returned. The lesson apparently had not been learned. Stock markets surged past pre-crisis highs by 2013, a rally fueled entirely by free money. Zero interest rates funded a new boom, Silicon Valley built campuses, tech unicorns multiplied, ping-pong tables and free lunch. Venture capital burned through billions. The new excess looked different, but smelled the same. In dark warehouses, from 2009 onward, machines mined cryptocurrency, a parallel money born from the wreckage of 2008. Bitcoin's price chart went exponential, the digital answer to institutional failure or the new tulip. Nobody agreed. Co-working spaces with exposed brick and neon, the everything bubble extended to commercial real estate, to startups, to aesthetics. In Europe, by 2014, interest rates went negative. Banks charged you to hold your money. Luxury queues lengthened while food banks expanded. The K-shaped recovery, one line up, one line down. Delivery riders waited in the rain, the other side of the recovery. The gig economy as permanent precarity. Amazon warehouses stretched to the horizon. The new economy of speed and scale and workers who couldn't afford to stop. Trading apps gamified investing. Confetti animations for first purchases. Speculation as entertainment. GameStop, January 2021. Reddit versus Wall Street. The system's logic turned against itself. Digital art sold for millions as NFTs. Scarcity manufactured by code. The new tulip or the new Rembrandt. Time would tell. Blank check companies listed on exchanges, SPACs, speculation stripped to its purest form, a bet on a bet. One electric car company was worth more than every other automaker combined. Valuation had become an act of faith. Diamond hands to the moon, investing as meme, as identity, as community, the language of money changed. Office buildings emptied, for lease signs multiplied. The pandemic accelerated a hollowing out that was already underway. In 2020 and 2021, stimulus checks arrived in mailboxes, government money direct to citizens. Empty shelves in supermarkets, supply chains buckled, the physical world reminding the digital one that atoms still mattered. By 2022, gas prices climbed, grocery bills swelled. Inflation, the ghost that central bankers declared dead, returned after 40 years. The Federal Reserve reversed course in 2022. Rates rose. The free money era that began in 2008 finally ended. The hangover began. Silicon Valley Bank, March 2023. The bank run, the oldest crisis in finance, unchanged since the 1800s, returned. The yield curve inverted, the recession signal that has never been wrong, flashing again. Empty malls, escalators running for no one, retail space as archaeology of a previous economy. Student debt statements on a young person's desk. Debt that follows you forever. the new indentured servitude. A gig worker checking apps in a parked car, multiple platforms, no benefits, no floor. The new labor market. The national debt clock in Times Square. 34 trillion. Numbers so large they've stopped meaning anything. Central bankers chose their words with surgical care. Each phrase could move markets. Language as monetary policy. The glass towers still stood, still lit, still trading. The machine survived its own malfunction. A new generation at the screens, younger faces, same blue light, same posture. The cycle continuing. Global debt reached 300 trillion. The number was so large it had become abstract, which was exactly the point. Behind thick vault doors, gold bars sat in rows, the ancient hedge still hoarded, still trusted, after everything. Exchange rates floated. The world Nixon untethered still drifted, still uncertain, still functioning somehow. Financial advisors offered reassurance, charts on the wall, a steady voice, the professional management of anxiety. In God We Trust, printed on every dollar, the most honest thing on the bill. The bell still rang every morning, the ritual performing continuity, tradition as reassurance. Sovereign bond yields, the heartbeat of government borrowing, still beating, still anxious. The IMF building in Washington, flags of every nation, the international architecture of managed crisis, still managing. Fiber optic cables under the ocean, light pulses carrying money at the speed of light. The new infrastructure, data centers in fields, cooling towers humming. The new geography of finance, servers replacing skyscrapers. A microprocessor, billions of transistors, the brain that would replace the trader. Algorithmic trading, code scrolling faster than any human could read. The machine learning to trade without us. Dark pools, anonymous exchanges, transactions hidden from public view, money in the shadows. Millisecond advantages, nanosecond arbitrage, speed as the ultimate currency. Server racks inches from the exchange, proximity measured in nanoseconds, physical closeness as financial advantage. A flash crash, the market falling 1,000 points in minutes, then recovering, algorithmic panic at inhuman speed. An empty trading floor, screens still glowing, no humans needed. The transition was already complete. A programmer in a dim room, 3 monitors, code that would execute trades no human would ever see. Smart contracts on Ethereum, code as law, the promise of finance without trust, without institutions, without people. A blockchain visualization, nodes connecting across a dark map. The distributed ledger, YAP stones, reimagined in code. A central bank digital currency, the government's answer to Bitcoin, control disguised as convenience. Quantum computing, strange machines in supercooled chambers, the next disruption, still in embryo. A blinking cursor on a dark screen, the future of money waiting for input. The Lehman building still stands. Different name now, different tenants, the street moved on, the questions didn't. In a museum, the crisis sits behind glass, a badge, a notice, a newspaper, history already. Scholars study what happened. The books are thick, the lessons are thin. The banker went back to work. The homeowner didn't go back to their house. 2 recoveries, 2 Americas. No major banker went to prison. The scales of justice tilted quietly in one direction. Recovery, said the front page. Below it, a photo of a food bank line, 2 truths on the same page. An ordinary person reading the financial news. Glasses, park bench, newspaper. Navigating a system designed to be incomprehensible. A piggy bank above a pile of financial statements. 2 ideas of saving, 2 ideas of the future. Years later, foreclosed houses got new paint, new owners. The physical recovery lagging the financial one by years. Trust carved in stone above a bank entrance. weathered by time, cracked by events. The Ming printing press, the Federal Reserve balance sheet, 6 centuries apart, the same temptation, the same answer. A Weimar wheelbarrow, a modern stimulus check, the scale changed, the principle didn't. A Lydian gold coin and a Bitcoin logo on a screen, the first money and perhaps the last. The bookends of this story. A rhinestone and a blockchain, distributed ledgers separated by millennia, the idea that keeps returning. A Mesopotamian clay tablet and a CDO prospectus, 5,000 years of recording debt. The format changes, the promise doesn't. Bank branches closing, apps opening, money migrating from buildings into screens. Tap, beep, done. A payment made without touching anything. Money as pure signal. Checking net worth on a phone at midnight. Wealth as notification. Anxiety as app. Monetary policy as background noise. A press conference playing on a laptop while someone makes dinner. Where did the money go? The question on a protest sign, the question of the era. A door opens to a server room. Cold blue light spills out. The algorithmic age begins on the other side. A satellite dish pointed at the sky. Money becoming signal, signal becoming light. Code scrolling on a black screen. The new language of value, unreadable to most humans. A phone showing a dozen financial apps, each one a different kind of money. Fragmentation. A child tapping a screen to buy something digital. A generation that may never touch physical money. A retinal scan for payment. Your body becoming your bank account. Identity as currency. A drone delivering a package tracked by GPS, purchased by algorithm, the supply chain of invisible money. Surveillance cameras on a corner, each one a potential node in a financial monitoring network. A social credit score on a smartphone, money, behavior, and obedience converging. The White House, the Federal Reserve, a tech campus, 3 centers of monetary power converging. Wall Street reflected in a rain puddle, the reflection more distorted than the reality, or perhaps more honest. A long corridor, fluorescent lights, a vanishing point, the passage between one era of money and the next. A dollar bill crumpled in a fist, the physical act of devaluing a symbol. A screen freezes, a buffering icon spins, the moment between the world of paper and the world of code. Manhattan at dusk, windows lighting up one by one, each light a transaction, a debt, a promise, a person. The charging bull at night, long shadows, the street empty, the symbol alone. A hand reaching for a door handle, about to open into the algorithmic future. A blinking LED in darkness, red, green, the new heartbeat of money. The 2008 crisis revealed something that was always true. From the Lydian Mint to Lehman Brothers, the system runs on trust, and trust can evaporate overnight. We printed our way out. We always have since the Song dynasty in the 11th century. But the printing press, as every era teaches, has a memory. The question is no longer whether the machine works, it's who the machine works for. Next, money disappears entirely into the servers. The algorithms that emerged in the years after 2008 take over. The human element is removed. The architecture of value continues. The architecture of value. Episode 7, The Lehman Moment, September 2008, a date that echoes the fall of Rome, the collapse of Potosi, and the burning of French assignats. Next episode, Episode 8, Algorithmic Value, the code that replaced the banker, the server that replaced the vault, the algorithm that replaced trust,